Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Matt Picheny. Matt is a Tony Award winner and a real estate investor with over 15 years of experience revitalizing and elevating communities, and has invested in over 8,000 apartments throughout the United States. Thank you so much Matt for being on the show.
Oh, it's my pleasure. Thanks for having me.
So you have a very interesting background prior to getting involved in real estate. Give us a little bit of background on yourself, both personally and professionally, prior to getting in and getting the real estate bug.
Yeah, I grew up in Orlando, Florida, and I started doing some acting as a kid. You know, I enjoyed doing that in sort of community theater, and then ended up doing that a little bit professionally, actually, when I was a kid, because I got cast as at Disney World. I actually worked at Disney World at the age of around 11 years old. I was singing and dancing in front of the castle at the Magic Kingdom when I was younger, and so that was a lot of fun. And then I started doing that once I got to working age. You know, once I was 16. While my friends were flipping burgers at McDonald's, I was dressed, covered from head to toe in fur on Main Street, USA, at the Magic Kingdom, signing autographs and taking pictures dressed as, you know, Disney characters. So it was a cool job, certainly out of the ordinary and a lot of fun, and continued to pursue community theater, and, you know, I was in the High School Musical and all that kind of thing. I moved to New York City in 1992 to pursue a career in theater. I went to the American Musical and Dramatic Academy and graduated from there. 3 days after graduation, I was off on tour, doing a tour, a theater for young audiences tour. So I was performing for little kids all across the country, and ended up, having a career as a professional actor for 5 years. I was in 15 different professional productions all across the United States. It was a blast. I started tinkering around with computers as a hobby, and we're talking about the mid 90s here, and had some opportunities to do that. So I ended up creating, ultimately, this is a little bit of a longer story, but the Cliff Notes version, creating my own boutique agency in New York City, where I was doing website development and other sort of digital marketing projects for clients up until 2001, when the dot-com bubble burst. A lot of clients were going out of business, and my landlord calls me and tells me I've got 90 days to move out of the house, the apartment I was living in. So here I was with a business that was literally imploding and about to have no place to live. So I got a job in-house at Showtime, the cable television channel, a client of mine. They offered me a job in-house. So I did that. And instead of renting an apartment, I bought one. And then I sold it about 2 years, a little over 2 years later. And I saw my initial investment quadruple.
Wow.
Yeah. And so that was a big light bulb moment for me. And that's when I started getting involved in real estate.
Awesome. Very cool. So after you had, you had that awesome return on your first. I guess you weren't even thinking it was probably an investment at that point. You were just finding a place to live because you're kind of pushed into it. What did you do as your first, I guess you would say, first investment that you actually, it was actually, you were, really focusing on it being an investment, not just something you're living in?
Yeah. My definition of what an investment was sort of changed over time because, I was buying a primary residence, but I also felt that it was an investment. I didn't really know what that meant. And I used the proceeds from that to buy another property. When I bought that one, I moved into a part of town, not a bad part of town, but just not the place where I wanted to live. So I was able to buy a place in the area that I wanted to live and was looking, how do I get more involved in real estate? And what I ended up doing through some other chain of events and circumstances, I ended up buying a piece of property, a raw piece of land in a community, a lakefront community. It was not lakefront property, but a lakefront community in Northwest Connecticut. And my thought at that time, when I first purchased the land, was, hey, this will make a good investment. The land will go up in value. It's in a wonderful community, but ultimately, maybe I'm going to build on this property. And a few years later, I did. I built a house on the property. And my thought at that time was, okay, I'm going to build this house as a vacation home for me to live in. But the price to build the house was going to make my mortgage payments a little bit more than I was comfortable with at the moment. And I was, still young and upwardly mobile, and getting promotions and things like that at work, and felt like, well, eventually I'll be able to cover the whole thing. But for right now, I know that I can rent it out a little bit here and there, and that'll help defray the cost. So maybe I'll rent it for like a month or two during the summer, just to help, make everything a little more comfortable. During the course of planning and then building the house, I end up meeting somebody who, spoiler alert, ends up becoming my wife. And her family had a piece of property on the other side of the state of Connecticut, and we're very seldomly there. So this really became a full-time rental for me because I was able to generate income from renting it, and we would hang out over, at her parents' place. So that was a good opportunity for me. Now, had I known that that was going to happen, I probably wouldn't have built the house if I had done the numbers, because the bottom line is, even with it rented out, it was short-term rentals, but about almost for, pretty much the whole year, I was just pretty much breaking even. So it wasn't really worth like the time or the effort involved now, sort of looking at it in hindsight. But I also learned so much by going through the process I learned literally from the ground up what it takes to build a piece of real estate, right? And I learned all about rentals and dealing with tenants and why property management is so important, because I didn't have it. I was managing the whole thing myself, which was a lot of time and effort, right? And I also learned about the really fun stuff, like the taxes and accounting type of stuff, right? I didn't know what depreciation was. I had heard of it, but I didn't understand what it was, and how wonderful it can be for a real estate investor to be able to have depreciation. And so those were all things that I learned while having that property. And it was never a primary residence, was never a residence of mine. It was always a rental unit. So that really was my first investment property. And it set me on the path to where I am today. Now, I own thousands of units across the country.
Hey, so what is your current investment criteria and strategy for what you're doing now with investing?
So I have a two-pronged strategy when it comes to real estate. When I talk about my real estate portfolio as a whole, I have over 8,000 units that I'm invested in, right? Partial ownership, fractional ownership. I don't own all 8,000, all 100% by myself. These are all done through syndications, and 2/3 of that portfolio, so a little over 6,000 units, are deals that I am a passive investor in. So I'm a limited partner in those deals. I vet the person who's running the deal, the location, and the deal itself, and then I put my money in, and that is basically all that I do. I keep an eye on how things are doing, but as a limited partner, I don't really have control over those deals. And then the other third of my portfolio, so a little over 2,300 units, are deals that I am a general partner on. And so those deals I'm involved in, I've been involved in, the acquisition of them, and I'm involved intimately in the asset management of those. I have other investors that I brought along with me. I put my own money in the deal and get money from other investors, and then we're able to get these otherwise unobtainable assets, as I know you do, Charles, right? We syndicate our deals. So for me, to be able to put $2 to $3 million of equity into a deal was never something that I could do on my own. And I wanted to know, how can I get these larger deals where I can take advantage of these economies of scale, and found out about syndication, where, a lot of investors can come together and pool our money together, and maybe I'll put $100,000 in, right? And then we're able to buy those bigger properties and be able to have those efficiencies.
So Matt, what is your role on your syndication team when you're active in the deals?
So my role is really when I worked in New York City. I think I mentioned earlier that I had taken a job at Showtime, and then I moved on from there and worked at many different advertising agencies over an 18-year career in New York City. And my role was, I'm a project manager. I'm a PMI certified project management professional, which means that I'm really good at managing people, budgets, and timelines. And so I take those skills that I learned and I apply those skills in the digital marketing world. But I've applied those same skills to doing that just in the real estate sphere, right? I did real estate as a hobby for 10 years and then transitioned into doing that full time over 6 years ago. And so I use all those tools and tricks and techniques that I learned from project management and apply those to real estate. So while I am involved a lot of times in identifying properties and the whole acquisition process, from the underwriting to raising capital and jumping through all the hoops we need to with our lender, going through due diligence and getting the deal across the finish line in terms of the acquisition process, then that's when the hard work really begins, because at that point I am on a call and on a weekly basis with our property management company. And actually the portfolio has gotten so big that I've hired another person to help me out. Also, I've got a director of operations who helps on the asset management side of things. And we are on those calls on a weekly basis, and using those tools and techniques from project management. Actually, my director of operations used to work for me back in the advertising agency days as well. So he's also a project manager and really good. And I actually trained him. So we have the same sort of philosophy when it comes to managing projects. And so I have, KPIs and a dashboard that I've created, and when we review that with the day-to-day project management team. So we use third-party project management, property management at the properties, right? And we are making sure that everything is running smoothly. And when things aren't, we're helping address those situations. So I speak with my best performing properties once a week. The ones that aren't performing great, if there's issues or things that are coming up, we're involved more frequently. We may have other meetings, we have phone calls, we have emails. And that's really what happens during the hold period, which is, usually, estimated to be about 5 years. We've been exiting our deals lately a bit earlier because the real estate market has had these tremendous tailwinds behind it. And we've got good, when we're outperforming our pro forma, right, our projected returns for our investors, then we feel, hey, maybe it's time to, and we used to get votes from our investors, and the votes were almost unanimous, like sell it, sell it, sell it. When you have these really great returns, lock in those returns and eliminate risk. So we've been doing that a lot lately, but the goal is to hold them for about 5 years or so. And then the disposition, there's not very much involved in that. That's a lot of the broker and us just making sure that everything makes sense and tying up loose ends. But the real work's during that whole period.
How vital are good property management companies when you're investing in real estate?
Oh, they're
working with them all the time. Yeah.
Yeah, I mean, they're key. And, one of the things that my partners and I are discussing is, hey, does it make sense for us to go ahead and vertically integrate and create our own property management team? Because we have enough scale at this point where we've got a lot of units, but there's pros and cons on both sides of it.
Yeah.
So we're weighing those right now, but that's going to make or break the deal. Property management is going to make or break a deal.
Yeah.
We've had to, in the past, fire property management companies that weren't doing what they needed to. We're not able to execute our business plan and bring in a team that could. And so it's unbelievably vital.
How have you found the property management companies that were good for you?
Word of mouth. And so that word of mouth can either come from other investors. That's always really good. I also, when I'm in a market and I get to know people, I get to meet hopefully everyone in the market. And that includes brokers, that includes property managers, and also hopefully vendors, right? So that we get to a point where we have certain vendors that we like, that we work with a lot. We have certain property management companies that we work with. And sometimes I'll work with one property management company, but I've got my eye on another one just in case, these guys, things fall to the wayside a little bit. We have somebody waiting in the wings that we can bring in if we need to. And like, I'm a loyal person. I like to create longstanding relationships as long as everybody is performing well, but if they're not, then sometimes we have to look for alternatives.
Right. So it usually surprises people when I tell them I'm an active syndicator and also a passive investor. So why are you also a passive investor with having so many units as an active investor and being very well versed in the whole active syndicator profession?
Because I don't want to get bored. Seriously, I think that a lot of people who are actively syndicating deals keep a lot of capital for themselves to deploy onto their own deals, which I think is good. I always invest in my deals. I'm usually investing significant amounts in my deals. But when I first started off, it took me 2 years to get my first deal as a syndicator, as an active investor. And during those years, I started investing passively. I had money. And that was that I wanted to invest in something. Might as well invest in something that I was, that I'm very good at. Yeah. And the thing for me is, I didn't want to. I wanted to go down sort of like two separate paths. I don't think that they're. I don't think you have to go down one or the other. And being that I had some capital that I could deploy, I thought, why don't I go ahead and deploy it on these deals? And sure, I'm not active in them, but I'll still learn from watching the syndicator, learning what they're doing, seeing what their reports look like. And if there's certain thing, they'll run into situations which they have, and then I find out how they've dealt with it. That helps me a lot. And, I learned as an investor things that I like in the communication from the syndicators and things that I don't like, a lot of oh, well, I definitely don't want to be like that guy, or, oh, I kind of want to emulate this technique or this thing that this person uses. So I've been able to do that, but also, look, I can't be an expert in every location in the US or even in the world if I were to start investing outside of the US, which I haven't done yet, but I'm open to possibly doing that. But I can't be an expert in every market, and I can't meet everybody in every market. And sometimes deals, my first deal I got through through a random broker who doesn't do a lot of volume, and I never knew about her. But the property management team that I was hoping to work with managed the property, and they knew that the property was going to be listed for sale and clued me in on it and introduced me to that broker. But so I can't know every broker. I can't know every property manager. And so there's other people who are experts in other markets. And so I invest with them in those other markets, or even in markets where I'm active, if it's a good deal. I mean, I know especially if it's like in Dallas where I have a lot of property. If someone shows me an offering in Dallas, I can tell if it's a good deal. And like, I can really tell. I really understand the market intimately. And if it's a good deal, why would I let that go by? So I'm developing a completely passive income stream, which is, done so well that, look, the bottom line is when it comes to the active investments, I don't have to do any deals. I've got good passive income. Also, my wife has a nice job. Like, I'm not driving a Maserati, but I'm also, I could be okay if we had to go a year or longer without doing an active deal. I don't need those fees. I don't need an acquisition fee or asset management fees. I don't need those things, which I also think gives me a bit of freedom to be a little more discerning in the deals that I do want to get involved in from an active perspective.
Yeah, I like that too, where they always say, well, people should be full-time in real estate. Well, you can be full-time in real estate, but also having income streams outside of your syndication business, whether it's in real estate or in other businesses. And I think that you have a lot of syndicators now that go full-time. The only way of really making money initially is all by acquisition fees. So you're taking down deals every quarter, let's say, if they're good, if they're not so good, whatever it is that they do just to churn those acquisition fees. And you have to be aware of that with whoever you're investing with, what their background is, and if you're comfortable with that. Because when you see a deal from someone that you maybe get one a year from or two a year from, you're like, well, this is probably this person really goes through and makes it they really do their due diligence on it, and they're not they don't need it to keep the lights on, their acquisition fees. So I think that's something you see a lot right now in the syndication business.
I would agree with you. We're always looking for deals, but we generally find 2 or 3 a year that actually makes sense. Sometimes it's 1 a year,
Mm-hmm.
It could be 4, who knows? We're just continuing to look and try to find things that make sense. But, people who have who aren't just in it to turn those acquisition fees, I think is important. That's one of the things you want to look for when you're looking at the sponsor that you're investing with. You mentioned, I think in the intro, that I've got this book, right? And in the book, I share the things that I've learned, through my journey. And one of the things I talk about is like looking at the sponsor and trying to figure out what they're about, what are they looking for, and how are they approaching deals.
Yeah. So what do you think, from looking at so many different deals and investing in so many deals, what are common mistakes you see real estate investors make?
Not being educated enough in syndications and the underwriting of syndications to truly be able to vet them. You've got people out there who are sponsoring deals who have a good track record, because quite honestly, if you've been any good, if you've been halfway decent in the past 10 years, you're probably gonna have a good track record. The market's just gone up and up and up. Yeah. It's kind of been hard to lose money in real estate in the past 10 years. So some people, hey, I've got this great track record. I'm like, yeah, they have, because they've been very lucky because the market hasn't turned. But I've been looking at their deals for the past 5 years, and they've been underwriting stuff that I thought was way too risky. They've beaten me out maybe on a deal because I just wasn't willing to overpay, and they were, and it's worked out in their favor now. But as a passive investor, I'm not necessarily invested in their deal. And that's really the whole premise behind, I hate to bring it up again, but I don't hate to bring it up, but just bring up that book again. It's just the book that I wrote is to help passive investors be able to sort of peel back behind the curtain. It's called Backstage Guide to Real Estate. So kind of a nod to my theater background, but really kind of like going backstage and seeing the inner workings of these deals and understanding how the mechanics, exit cap rates and rent growth, and how much are they increasing the rents off of where they are now, and does the household income in that particular area really support that, and things of that nature that I think you need to being a passive investor is great, right? And it's billed as, hey, make money while you sleep, right? And that's true. You can make money while you sleep if you're in the right deals, but there is a baseline amount of education that you really need to go through. Once you have that baseline education, it starts getting easier, but then you still need to really vet the sponsor. And then each deal that comes through that sponsor that you vetted, you're applying the education that you have to make sure you feel good about the market, you feel good about the deal. So there is a bit of work up front. At this point, I've been doing this for many years now. It's seldom that I'll bring in a new sponsor that I'll invest with. And if it is, it's someone I've gotten to know over a couple of years and that other people have recommended to me, right? And then, once I've vetted them and feel good about them, but they have a deal come in, I can look at it really quickly and decide. So I don't spend a lot of time on the passive stuff. I mean, it really is passive. There's a little bit up front to take a look at it, spend a half an hour to an hour, maybe looking at a deal, make a decision to go in or not, and then, move on to the next one. But there was years before of education and learning by investing in bad deals, right? To get to the point where I am now.
When you were making the transition from going part-time in real estate to full-time, it was the passive income, you got your passive income to a certain level before doing it, or did you want to get your active business to a certain level before you did it? Because the passive incomes, that's something I think it's much easier to calculate when you're passive on a deal versus because when you're active on a deal, you might not be getting paid other than the acquisition fee for the first couple of years, really. So it's a little more difficult, you know what I mean? Or you're not getting much money. You're right. No.
Yeah. On the active side, I'll loop back right around to your question and get to it. But just on the active side of things, I didn't take an acquisition fee for the first couple of deals that I did. I do now because I have a track record, and that's one of the things I kind of warn people about, like, well, wow, this guy's never done a deal before and he's taking a 3% acquisition fee. That seems a little, So, but I take one now, but in terms of those active deals, it's really once you have several of them where the income starts to stack up, right? Because you might only be making $20,000 or $30,000 or $10,000, just sort of depending on the deal, the size of the deal on an annual basis. So, if it's 20,000, once you have 5 of them, then all of a sudden, you're talking about 6 figures of income, right? Then you've got expenses too, but it takes a little while. I'm agreeing with you to build that up. So, and that's another reason why I did the passive investments. I didn't have a plan. Some people find out about syndications and figure it out and sort of map it out. Okay, I'll start making this much passive or start making this much active, and then I'll get to a point. Then they're doing that like while they're working a W-2 job, and then I get to this point where I make that leap. That didn't happen for me because my leap was made when we had a bit of a life-changing moment where we moved from New York to Miami, Florida, because my wife got a job opportunity. And so with that job opportunity, we had purchased a place in Brooklyn, a 2-family property. And with the move, we were able to rent out our unit, and we were nicely cash flow positive. So I had passive income coming in from there. So my wife works in theater and I have that theater background, and we invest in Broadway shows. And so we had invested in Hamilton, which was doing very well. It still continues to, but it's doing very well at that time. So we had passive income coming in from that. And we moved to Miami, and I thought I would get a job in the advertising world. That was my intention when we moved down there. Okay, my wife's got a job. For us to make the move, it was like, there has to be enough to pay the bills and at least allow us to eat PB&J, right? And her salary came in and was a little bit lower than what we were hoping, not what we were hoping for. She got paid well, but that what we were going to need. But because we had these other sources of passive income, we said, okay, we can make this work until I get a job, and then I'll get a job and we'll be great. So we moved down to Florida, and I started looking for advertising jobs. And so in New York, after climbing the corporate ladder for 18 years, I was a vice president. I was managing teams of 100 people or more in multiple countries, working on projects for Coca-Cola and Verizon and Visa. And I go into Miami and I walk into an advertising agency, and there's like 5 people in the agency. So it was on a completely different scale. And once I had any conversations with people about salaries, it was like, wow, I can flip a property and make that kind of money, so it just didn't seem to make sense. And I kind of was burned out from the agency world, having done it in New York City. Most of that time I was single, so I was really burning the candles at both ends. I didn't care. I'd work till midnight. I didn't have a family to come home to or anything, so it was like fine. And so I was just kind of burned out from that. And at that time, I was listening to Robert Kiyosaki's Rich Dad, Poor Dad. I had an audiobook of that. So I'm listening to Kiyosaki talk about building passive streams of income. I'm like, oh yeah, I need to do that. And then when I'm not listening to that, I'm listening to the Hamilton cast album, because we were investors in it, but we're also just huge fans of the show. We used to listen to that all the time, especially back then. It had just come out. And so I'm listening to the cast of Hamilton one day, and they're singing the song, My Shot, and they say, take your shot, take your shot, take your shot. And I just got done listening to Kiyosaki saying, build passive income. And I'm like, what am I doing? Like, why am I trying to get this job in advertising? And I'm burned out. I've been doing real estate as a hobby for 10 years and making good money as a hobby. Why don't I take my shot? And so I sat down with my wife and talked with her about it and got her blessing, thank goodness. And I started a career in real estate investing. And it took me quite a while to get regular income from it, right? And build a business and put myself on a payroll. But now, I've been in it for 6 years. A lot of my passive investments have gone full cycle. They might be generating anywhere from 7 to 10% cash on cash. So, if you have $100,000 invested, you're talking maybe like $7,000 to $10,000 a year. That's not a lot. But then all of a sudden that property sells and you get a check for like $150,000. Yeah. And you're like, oh, wow. Okay. That was nice. Right. And then reinvest that and put that in. And so that's grown. So now that I have, it took a few years, it's kind of like planting a farm rather than hunting. If you want to talk about acquisition fees from an active investing perspective, okay, that's like hunting, right? You see the big deal, you get it, you kill it, you get a nice chunk of money, and then you eat on it, and then you're done, right? And then it's done though. Well, but the passive investing, and also it does work this way on the active, you're planting those seeds that grow over time. And so now, over 6 years into this, I've got a lot of different crops that are at different, phases in the life cycle. And so I have certain ones that are ready to harvest and certain ones that I'm planting new crops or they're midway through. And it takes time. This is not an overnight kind of thing. It takes time to build it. And thank goodness we had those other streams of passive income, and we lived pretty modestly when we were in Miami for those couple of years that we were there, to allow us to sort of grow our farm. I don't know.
Nice. Very interesting. Yeah. So wrapping up here, what do you think are the main factors that have contributed to your success, Matt?
Well, education is key. And then beyond that, there's certain traits that I think are great, in life as well as just real estate. And that's persistence. That's one of the keystone concepts I talk about in the book, right? Being persistent in a nice way, not being obnoxious, but that's really helped me in every deal that I've gotten, has been both persistence and also relationships. Building those relationships, building that network is of the utmost importance when it comes to commercial real estate. Building those alliances with brokers, with property managers, with other investors, with general partners and limited partners. I have a guy that we both general partner on deals, and we've never done a deal together, and maybe we will, but we both also invest as a limited partner, which you do, I know, Charles, as well, which is kind of rare, right? Like, I don't know any other GPs except for you and him who very not actively, but frequently invest as a limited partner. And he and I, we get on the phone and we trade stories on different spots. Hey, have you invested with this one? What did you think of that? How did that one do? And so that's really important for me as a passive investor, is being able to talk with other passives. When I like, hey, Charles has got a new deal. Hey, have you invested in a deal with Charles? Like, is he good? How did it go? Was he communicative? Like, how is, all of those things are important to know.
Yeah, no, it's very good too. And the other thing too is when you're vetting out your partners to work with on the active side, a lot of those that we work with, myself or one of my partners has been a passive investor previously on a deal that's gone full cycle. So you know exactly what reporting is, you know exactly how the underwriting is. We've had that underwriting checked out on other deals with other underwriters, so you're like, you really have a good feel for, it's not just you meeting at a conference and be like, we get deals and we need some, what I mean? We need partners. It's really like, hey, we've worked with them. And then it's like, you have an idea of exactly many years of, returns, many years of communication, because communication, as it's funny that you bring that up. I feel it's one of the biggest things that a lot of syndicators lack on. And it's when I talk to passive investors, it's usually not, we got money from, not that we lost money on a deal. It's really that, the communication. I had no idea what was happening, or it's like, what I mean? It's like 3 bullet points or something sent to me monthly or whatever. And, in the last 10 years, that's great because it's very hard, like you said, to lose money. But I mean, we go into another phase of real estate, another part of the cycle, and not every deal is going to be making money.
That's very true. I think you brought up some great points there.
So tell us how we can learn more about you, your business, and your book, Matt.
You can find out about all of those things on my website. So it's Picheny.com. I'll spell that real quick. It's P like in Peter, ICHENY.com. I'm sure you'll probably put a link to that in your show notes. But you can go there to find out more about the book and order the book. It's also on Amazon. You can check out our blog. I'm always posting educational information for investors to learn. And you can also sign up for our monthly newsletter that I send out that has investment tips and tricks in it. So that's all on the website, Picheny.com.
Yeah, I was looking through his website the other day. It's very informative. There's a lot of information there, so make sure you check it out. The link will be in all the show notes. And Matt, thank you so much for coming on. It was great having you here, and looking forward to connecting face-to-face sometime in the near future.
Yeah. It was great meeting you too. And thanks for having me as a guest.
Talk to you soon.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.